Good afternoon. My name is Cherie Andre, and I am the Client Relations Manager at Prestige Wealth Management Group. And I would like to welcome everyone to our Economic Update webcast. I will be the moderator for today's event, as always. And our goal is to continuously add value for our clients by helping to educate you and keeping you informed. I don't know where I went. Today's discussion will be hosted by Roy Williams, President and Founder of Prestige Wealth Management Group, and John D'Angelo, Managing Director of Prestige Wealth Management Group, and our newest team member, Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in a listen-only mode and should last approximately 30 minutes. No participation is required, and there's nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and questions to pwm@prestigewmg.com. I do want to take a brief moment to welcome Paul Esposito.
Thank you. Thank you very much, Cherie.
And tell everyone a little bit of background about yourself, if you don't mind. Is that okay? I'll go and do that.
Yeah, if you want to do that for me, I appreciate it. Thank
okay.
you.
Well, we welcome you here. Paul has over a decade of investment management experience. And prior to joining Prestige, Paul was the portfolio manager for Alliance Wealth Management Group in Flemington, New Jersey. In this role, he was responsible for creating the firm's investment process and managing client portfolios. He was also a portfolio manager for the Northeast region of Wells Fargo's Trust Department in Wilmington, Delaware, where he managed trust and private wealth accounts exceeding $400 million. Paul began his career at Vanguard in Malvern, PA, where he provided wealth management services to both institutional and individual high net worth clients. Paul earned his Bachelor's of Science degree in Finance from the Haupt School of Business at St. Joseph's University in Philadelphia. He also holds both the Chartered Financial Analyst, otherwise known as CFA, and Certified Financial Planner, CFP, designations, and is an active member of the CFA Society of Philadelphia. In his free time, Paul enjoys spending time with his wife, Nicole, and their twin daughters, Ava and Tessa, as well as scuba diving and water fishing. He also volunteers his time at a number of charities, including Project Santa, which is a toy drive for a local women's shelter. So please welcome Paul to the Prestige Wealth Management Group. And with that, here's Roy.
Yeah, welcome back, Paul. What Cherie failed to mention, Paul, early in his career, worked with us in
2007 to 2010.
So Paul has been through the financial crisis with us when there was that crisis. In just terms, starting out, recapping the first quarter, last year we had the lowest volatility in history. And the expectation for that to continue, was never expected this year. We really, have moved back to normal volatility, maybe a little bit more than normal. But, you have to understand when there's a 200-point drop or gain in the Dow, it's based upon 24,000. On a percentage basis, it's less than 1%. So we are having some wild swings in the market up and down on a daily basis. In terms of as we look at the markets, let's look at the CPI, Paul. So what do you think is happening with the CPI, in terms of this quarter?
Absolutely, Roy. So if we look at, there's a couple of inflation metrics going on here. Obviously, the one that we, at least the Fed pays attention to is the core PCE deflator. That's one of their policy metrics that they use to justify raising rates. February was a little soft at 1.6, but if we go back and actually look at the overall trend, the vector in the CPI, whether it's the core CPI or the headline number, you're noticing that inflation is on the rise. going back to 2015 and 2016 when there was a rout in oil and global commodities, and of course there was an earnings growth concern in the early 2016 period, you could see where the inflation numbers, were touching, almost to no inflation or a deflationary realm of the chart. So, right now the justification for the Fed raising rates, does seem to be warranted. And, inflation right now, I know that was one of the scares that we've had in the fourth quarter, along with in this first quarter, along with the trade war potential, which seems to have abated. But the inflation at current trends is not really running as hot as I think the market should be concerned about. And remember, we all know that inflation and market growth are not, mutually exclusive. You usually tend to get inflation if the growth dynamics in the market are, improving. Oil prices are much higher, so as a result, that feedback loop into inflation should denote a positive trend.
Now, John and I spoke about inflation a lot in terms of, the end of last year, and if we're having inflation, it could be a positive, right, John? And why don't you talk about the positive aspect of inflation?
I think one of the things that we talked about last quarter was the benefits of the tax cuts, that people are going to have more money in their pockets, and that was going to lead to a lot more growth, which leads to growing asset prices. I think one of the underlying symptoms, though, that comes with that is that if we look at inflation on a more of an anticipated, or what the expected CPI may be, is that we are expecting inflation to be higher, because that is one of the ancillary items that come with these tax cuts. So I do think that earlier in February there was some concerns around interest rates moving up, and those interest rates were moving up because there was a lot of anticipation that there'd be some inflation with tax cuts.
Yeah, one thing, I was at a conference recently, and Jeremy Siegel, who John and we all admire, from Wharton Business School in Philadelphia, most of the economists who spoke at this meeting believe, core inflation and is still going to be muted. Most of them don't believe we're going to go into an excess inflationary period of time. And frankly, the concern with tariffs cause extreme inflation, regarding food, regarding steel, regarding plane fares, everything. If Boeing charges more for planes and American Airlines pays more, you're going to pay more for airline tickets. It just transcends throughout the whole economy. So, that was a big concern.
To your point, Roy, if we think about it from the chart perspective, these headline CPI numbers, the core PC deflator, any of these metrics are below their long-term average.
Oh, without question.
So in essence, all we're doing is just normalizing.
Mm-hmm.
It's just an indicator that the economy is indeed healthy.
They are. So at present, a lot of these metrics usually tend to be seasonally soft in the first quarter. But looking at and that's in a couple of charts to come, where the Fed is setting its policy with regard to real GDP growth, the unemployment rate, as well as that PCE deflator that they're using for effectively inflation, they have adjusted the long-term targets, rather low. So maybe not all of those are going to meet target this year, but the anticipation is that by 2019 and 2020, based upon the trends in GDP growth, in the unemployment rate, which is very remarkably low on a 50-year and also historical since inception average, along with inflation, should get close to target. So I think really the big takeaway is from this, the whole discussion in inflation is that it justifies the Fed hiking rates, and I don't think we should be as uneasy about the Fed embarking on this rising interest rate environment, because let's remind ourselves this has been a very gradual lockstep approach. It is not as if former Chair Janet Yellen, when she started this whole process back in 2015, was trying to raise rates by 50, 75, 100 basis point clips. We're talking about slow and steady 25 basis point increases, and the Fed has, I think, at least done a good job in being data dependent. So when we see the market, or the fixed income market having interim shocks because the Fed wants to raise rates again, I think that is a lot of noise. We should also be very concerned that, that when the Fed raises rates, it's not when the Fed stops or when the Fed continues to raise rates that we should be concerned. It's when the Fed stops raising rates that we should be most concerned.
Yeah, and most economists again don't believe that's an issue. In terms of the dollar, after President Trump was elected, we saw the dollar by year end, go to $1.04 against the euro, and then last year, we saw the other currencies, euro, yen, all rally against the dollar. Quickly, why don't you just talk for a second, Paul, about that?
So I guess this chart serves two purposes. One, it's really to discuss the fact that a weaker currency trend has actually translated into very good foreign stock market returns last year, right? So you had a healthy year in both international and emerging markets, but what amplified that was the currency translation because the U.S. dollar went down. Other currencies, the euro, yen, rallied against that base currency being the U.S. dollar. The other, I guess, reasons why we have this chart here is really to explain how the declining dollar actually really supports the trend in rising inflation. To your point, as the dollar weakens, it makes net imports more expensive to us. It makes our exports cheaper, which also is a good segue into a tool that that we could use as to help with any type of tariff war in the future. Now I know the discussions that have been held with China and President Xi at least make it look like there's going to be some concessions on that front. But with a strong dollar, obviously is bad for our exports. Historically speaking, the dollar could weaken and does have a lot more room to weaken further. So that could be, a very nice boon to further U.S. growth if need be.
Yeah, and most economists, because there were, I guess, 10 or 12 economists that I heard speak, were predicting that the dollar would continue to weaken. It may gain strength for a short period of time, but over a period of time, weaken. In terms of the Fed, we hit on this already. The Fed increasing interest rates is not necessarily a bad situation. What's funny about this chart, and to me, my takeaway, if I look 3 years ago, the chart looks very similar to what it did 3 years ago. The Fed has moved very slowly to, again, this is the slowest the Fed in history has ever moved in terms of increasing rates. And it's a positive to increase rates to give the Fed the ability to decrease rates if we have any type of recessionary pressure. Because when rates were at zero, there's nowhere for the Fed to go. And the monetary policy, there's really nowhere to go. So this will give the Fed some ability to decrease rates if we do have a recession in 2 to 3 years. In terms of full monetary policy, it's why don't we talk just for a minute about the U.S. monetary policy and what's going to happen, John, with the central banks.
Well, I think right now, certainly while the U.S. is in a tightening or tightening monetary policy, the developed world, the rest of the developed world, in particular Europe, is still far behind where we are from the standpoint of being restrictive. They're still in more of an easy monetary policy than we are. Because of that, I think what we've seen over the course of the last year or two is we've seen a recovery in some of those developed markets where Europe was lagging from a return perspective for several years in this cycle. Last year, we actually saw the developed markets have a return north of the U.S. market.
Yeah, and again, that's what's very difficult to predict. And that's what happens all the time. The worst performer, which was the emerging markets, the previous 4 or 5 years became the best performer in terms of performance.
Yeah. So I was just going to say, Roy, I think the big takeaway from the trend in the two forms of monetary stimulus and tightening. One is central banks can raise rates, their policy rate, or they can decrease them. If you look at the chart to the right and you look at the top 10 developed market banks, we've had we've had a handful of rate hikes so far in 2018. 2017, we were slightly over about 6 hikes when you factor in all developed central banks. Go all the way back to 2018, what do you see? You see cuts, right? And that usually signifies the change of a cycle. Looking at the chart to the right, I think it's important for us to understand that interest rate policy should not be looked at in a vacuum with the U.S. The balance sheet, the quantitative easing that central banks embarked upon, U.S. in particular, by buying treasuries and mortgage-backed securities, was another form on top of being able to cut interest rates to stimulate the money supply. And if you look at the overall total, the runoff on the balance sheet really on a net basis, when we factor in all major central banks, the Fed, BOJ, ECB, doesn't really start to get restrictive until the tail end of 2018 on a net basis.
Think about where the German Bund is trading.
That's right. You're still at a negative rate policy there. So for us, I think that everyone is again concerned that the Fed hiking the Fed funds rate is restrictive, but we kind of have to look at both sides of the equation because quantitative easing is really a policy tool that's been used really for the first time, en masse for this current cycle. So when we factor both sides in, we're still in a very loose monetary policy environment. And, as we approach the tail end of 19 into 20, that's where I think there's going to be some cause for concern. But we monitor these things. That's what we have to do.
And the Fed's made it obvious that if they need to pull back on the increases because of economic concerns, they will, as they have. How many times did we expect? Last year we were expecting 4 increases, which didn't happen. The year before we were expecting, multiple increases, which didn't happen. So the Fed, I think, will be keeping their eye on the ball and hopefully as we move forward adjusting.
In 19 and 20, though, too, what we'd have to keep our eyes on is if the Fed is going to continue to allow their balance sheet to shrink.
Sure.
Yeah, and even that will be monitored as needed. If they have to pull back on, shrinking the balance sheet, they will, and they've made that also. In terms of the bond yield, we've kind of hit on it a little bit. Interest rates have moved up. And what we've done, just to give you a little background, Paul, this week you analyzed our bond portfolio, and in terms of sensitivity to interest rates, we're really we feel, an excellent position with a little more than a 3-year duration and, a high-quality bond portfolio. And so we've taken action to reduce interest rate risk by reducing the duration, which is maturity, within our portfolio. And just because the Fed hikes short-term rates doesn't mean, and we've seen this, doesn't mean longer-term or 10-year yields will go up in step. Eventually they may, but in a short period of time, they're really disconnected in a lot of regards.
That's very good points. I think that the prolonged zero interest rate environment has really distorted the term structure of the bond market. So if you look at what the average yield used to be and also duration, which is a mark for interest rate sensitivity, bonds have become more interest rate sensitive because Corporations have been issuing debt at record low yields
Mm-hmm.
and very, very high maturities. So that's a big cause for
Very long maturities.
Very long maturities, as I find. And in looking at, there's a couple of metrics that we look at when constructing a bond portfolio for being defensively postured for a rising interest rate environment. There's something I utilize called a Sherman ratio, which basically takes the average yield that you're getting on a bond portfolio divided by the interest rate sensitivity or duration, and then factoring in credit quality. We always look for a number greater than 1. Right now, the ratio on just owning the flat-out aggregate bond market is about 0.5, which is very weak. It means you're getting a very incremental amount of yield for a lot of interest rate risk. Whereas in the analysis that Roy alluded to earlier, our Sherman ratio right now ranks at about 1.1 to 1.2, which is, in our view, tends to be very optimal.
Yeah. In terms of what do you and again, this is not to agree or disagree with the tax cuts. When we look at it, we look at the current situation we're in, and there were corporate tax cuts. When you look at the corporate tax cuts, these companies will J&J year-end, I guess it was $66 billion, bringing back to the U.S. John, what was Apple, 270?
It was, close to 300. It was a very large
and
number.
And some companies haven't declared yet in terms of, looking at Colgate. They haven't declared how much they're going to bring back, if any. But companies, what we're seeing with the tax rates, and to me, when I look at the year-end report on valuations, we're trading at 18.4, I think it was, or 18.2 was the number. We're down to 16.4. So from a valuation standpoint, are we overvalued? Are we not overvalued? If we have an expanding economy, and John, we talk about this all the time. We may not be overvalued. If we look at the earnings, which we will in the next slide.
Well, when you think about the market correction that we've just gone through, I think there's been a lot of fear around tariffs and around trade that kind of came from this initial fear around inflation and interest rates. And what we've got is a market that is much more reasonably valued on the heels of this incredible tax cut for corporations. So right now we're getting ready to get into earnings season, the first earnings season since the correction. I think what we'll be looking for is what these companies during earnings season are going to be projecting out for future quarters, right? Because this is not it's not fully realized yet, the growth. So I think if companies start forecasting higher growth for the remainder of 2018, and they start forecasting higher growth for 2019, then the markets most certainly would be more undervalued than even fairly valued potentially.
Yeah, and one thing when you look at earnings, Paul talked extensively about the dollar. When you have companies, almost half the revenue of the S&P 500 comes from overseas. So if the euro gets stronger, and now you're bringing euros back into dollars, it's beneficial to the earnings of these entities. A weak dollar. And again, when they put this cash, you had companies like Apple, it was dead money, just cash sitting overseas to avoid taxes. Now, Apple's, I think, in Arizona is going to open a new plant and employ 10,000 people. They're going to buy back stock. Right. You're going to see, Paul and I talked more mergers and acquisitions.
Dividend hikes.
Dividend hikes. You're going to see, we're seeing more companies coming public. So it's going to be, like Colgate I talked about. They hiked the dividend 5%. That's a tremendous increase of income for those who own Colgate stock, a 5% increase. So, but it may take a hit. You'll see some companies like J&J's earnings Paul, we talked about this in the last quarter, were weak because they had to pay all that tax on the $66 billion.
A lot of that is being accelerated. Certain companies took the charge in the fourth quarter. But overall, I mean, if we look at what the S&P 500 is set to do for earnings this year. Last year, the S&P earned $132 per share. This year, we're projecting $158. Again, there's some seasonal weakness in usually the first half of the year. Second half earnings tends to improve. But another interesting, fact is if we look at the earnings growth on a year-over-year basis for what's projected for this year versus where we were at the beginning of last year, the earnings growth rate was is going to be north of 17% on an expectation basis. That is the largest leap in growth rate since the beginning of 2011. So, again, not to say that the market, is necessarily rhyming with 2011, or at least, that year-over-year metric is a prelude of what's to come. But I find that actually very interesting because it does confirm that profitability should be higher. Obviously, the use of profits, with, as you've stated, with dividends, share buybacks, as well as the increase to CapEx, that is, sort of the catalyst that is going to keep markets in more of a growth mode for the latter part of this cycle.
And it really makes me somewhat bullish when you hear about Chrysler opening a new plant in Detroit. Detroit is a city that went bankrupt last year, I think, or the year before. That is optimistic that they're going back into Detroit and opening a car plant. But what's different this time, instead of employing thousands of people, they'll employ hundreds of people because of robotics. But we have a client who works on robotics, and they make a very good six-figure income. So the jobs will be high-level jobs that these people will be employed, high incomes that they'll be employed at. So that's, that's positive. They're not bringing back, you're not going to, and I don't think anything will bring back the lower-paying jobs that left after NAFTA was signed in '94, I think it was. Those jobs aren't going to come back because it's a lot cheaper to manufacture a dress in India than it is, or China than the U.S.
Yeah, agreed. The structural employment issue, and I'm pretty sure we could probably hold court on that topic probably for another hour, but it's certainly, it's fed back into lower inflation. So, that, I think that's something that we need to be cognizant of, the type of economy that we're in, the employment rate, and, the wage growth associated with, the structural employment issue in the United States.
Yep. And in terms of, you hit on earnings growth and, the cash return to shareholders, I think as all this cash comes back, you're going to see that number go to all-time highs. You even saw companies, I think a client at Home Depot, a retired client, got a $750 bonus. Walmart, I think it was, raised minimum wage. That's all favorable economic numbers, having that happen structurally, just naturally increase the minimum wage. That's favorable for the U.S. The U.S. economy. So we spoke about most everything here. In terms of the outlook, one consensus from all these superstar economists was we will continue this year. Everybody expects to have a higher level of volatility. And you're going to see a chart in a couple of charts that really lays out, that it is normal to have volatility. The past 4 years, Paul and John, have been abnormal in terms of how low the volatility is.
Well, I think one of the factors that certainly is in play this year, I don't know that it's been spoken about enough in the media, is it's a midterm election year. And midterm election years, typically, stock market returns tend to be choppy because you don't get much policy decisions during the course of that year. So between that and some fears around, trade, you're going to have increased volatility. In 2017, of course, there's no volatility because everybody was just expecting tax cuts that year. Well, now tax cuts.
And that was in anticipation, the low volatility everybody was anticipating, and we talked about as a team, those tax cuts, and we got them. So now there's no more anticipation for that huge benefit to happen.
And now the tax cuts are in the rearview mirror, I think the market is looking for the next catalyst. And while the market searches for a catalyst, markets tend to be uncertain, and uncertainty is the definition of higher volatility.
Yeah. And if you look at this chart, and that's what this chart shows, that obviously the financial crisis is not a norm. But beyond that, volatility. The next chart really shows volatility. I remember personally, I was in New York City for a meeting in 1997, and you had I'll call it a financial, crisis that year in terms of with long-term capital. The market, went down significantly, probably almost 20%, but by year end had a great year. And that's what this is showing. The red dots show in terms of the downward, in terms of the low point of the stock market that year.
Right. And what I think is interesting to point out, this is 38 years roughly, or 37 years of data on this chart. And if you look at every one of those drawdowns intra-year, what are you going to notice? That the market was negative at some point in the middle of the year. But what's the counter to that trend is that not every one of those years did the market end down. Actually, in fact, if you look at the numbers, only 8 out of the last 30 years did the market actually end at a loss, which means, if you're a probability person, approximately 80% of the time, the markets ended on a positive note.
After being down. After
being down. So we should not be, rattled by the fact that the market, for a particular quarter is down 3% or 4%. That is the, no free lunch policy of the market, and that we have to take some risk in order to get the particular returns we're looking for.
Well, and I also think it points out how unusual last year was. If you look at the chart, only one other time did we have a drawdown that was as insignificant as it was in 2017. So to Roy's point earlier, having volatility, or the volatility we've seen, is also normal for a market year. Mm-hmm. It certainly doesn't mean that the entire year is flushed because you have a correction.
Correct.
Yeah, and the next chart, I know John likes and we all like, because, if you miss the best 10 days of the market, you cut your return by more than 50%. If you miss the best 20 days in the market, you cut your return, down to 1.15%. On the flip side, somebody will say, well, if I miss the worst case, but it's what we find happens with most individuals. And I had a call from a very conservative client when the Bitcoin was at 17,000, I think it was, wanting to know what I thought and to buy. But historically, that's what people want to do. They want to buy and invest more when the market's up. They overexpose themselves to risk when the market's up, and when the market's down, they want nothing to do with it. And so normally you don't miss the worst days because you're invested, and then you'll miss the best days because you move the cash. It's very difficult to totally time the market. Right. What's important is, we believe is to, look at your allocation, and we preach as the clients that in your portfolio you only take the amount of risk you need to take to have success in retirement, meaning not to run out of money. In some cases it could be 30% in stocks, in some cases it could be 40%. John, myself, and the team, Alyssa, and the whole team here work hard at monitoring risk because, again, this, the last two slides point is very difficult.
This chart, for me, is the epitome of why you need to be a long-term investor.
For the equity piece, without question.
Absolutely.
Yeah. And if you think about it, you look at real estate. I know somebody who, before the financial crisis, owned about $10 million of real estate in Florida with a $4 million of debt. I begged them to sell enough to pay off the debt. They refused to and ended up losing everything. And again, that's what happens. You always want to have the right portfolio, and you don't want to use leverage, and too much leverage. You just want to be in a good position to succeed, because you can't predict. Even last year, nobody had a crystal ball. John, the night of the election, we were into the wee hours of the morning on the phone because the market was down 800 points. Not, what are we going to tell clients? And we wake up in the morning 3 hours later, and the market's turning, and we had a positive day.
That's why it's important, right, to be diversified. The only free lunch you get is diversification, to be well allocated, to manage risk. And if you do those things and you are a long-term investor, that equates to success when it comes to your long-term goals and objectives. So that's really, I think, what we try to do as an investment policy committee is try to make sure that our portfolios for our clients are best allocated and well diversified.
Yeah.
That's right. And I would add to that point that volatility, the whole context of an asset allocation is to help mitigate volatility with a stock-bond mix. I'll take it one step further and actually, incorporating volatility as an opportunity. Although we've had, I guess, slightly above average volatility this year, we haven't had extreme measures of volatility. But rather than running the other way, the way really to be profitable in this business is to embrace volatility and be a liquidity provider. And, I think that's something, that needs to be focused upon because, I'm not saying that you should become overtly defensive, in a time of volatility, or you should become extremely aggressive, but looking at our asset allocation and, discerning whether or not, an opportunity exists and using that opportunity, to help buy some riskier assets in those situations.
And we're talking about, as a team, the rebalancing opportunities. Last year in the portfolios, taking a little money out of emerging markets and moving into value stocks which underperformed. But the same was true in 16. Emerging markets underperformed, taking money out of, the performer, best performing asset class and buying emerging markets, and nobody wants it. But again, 17 turns out to be the best. So, throughout the year, we'll look at rebalancing opportunities. But if there is ever liquidity, and I went through this week with a client, where the market was flat, we raised cash because they were going to need money for a liquidity need. Anything that's needed for, purchasing a home or buying a car, that money really shouldn't be, and we as a team in the market and invested, that money should be in cash, to limit your risk exposure. I want to hand it back, and I want to thank everybody for the time today. And again, welcome Paul, and hand it back to Cherie to close it out.
Once again, thank you for joining us on this webcast, and we look forward to continuing these series of calls with you in the future. If you missed any part of this webcast, a replay will be available on our website shortly. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com. That's pwm@prestigewmg.com. Have a great day.